Hey, what's up, everybody? It is Tuesday, September 1st. Yeah. Groundhog Day. No, well, you know what I'm going to say. Another update in the market happens every single day. Very easy to explain, as I've been explaining now for a long time. Unprecedented, massive fiscal flows, fiscal support, just lifting everything up. We saw some really strong data too, and that is completely understandable in light of, record government spending. It's very easy to understand. It has nothing to do with the Fed. I know all the wackos and the zombies, they keep looking at the Fed. Every time the Fed says something, they're manic, they jump in, they jump out. No, you got to focus on the flows. That's the core of what I look at, and everything is positive. It continues to be positive. Record amount of spending, record year-over-year increases. The only thing that's not going in that direction, if you look at employment and withholding tax deposits, they are the year-over-year negative gap. In other words, they are down versus last year, and the differential is widening. So we may have a little bit of a disappointing jobs report on Friday. I think they're looking for 1.5 million in payrolls. We may not get that, but I don't think that's really a worry for the market at this point. For the market to correct, I know a lot of you are looking at this saying it's crazy, it has no connection to reality. It absolutely has a connection to reality. As I've explained so many times, these flows end up going to corporate profits, and you're talking about mostly these mega cap companies that have an inordinate pull on the market. They're dragging the market up, and it's just going to continue to be that way. And I don't necessarily think that the job picture right now, I'm not going to say it's not a factor, it is a factor, but as long as corporate profits continue to expand, and they will under this scenario of government spending, then the market's going to go up. And obviously some sectors are going to be way better than other sectors. But I'm not saying we can't have a correction. We absolutely can have a correction. But in order for that to happen, we need to see everybody all in. And I'm looking at the weekly AAII sentiment survey. Individual investors are still negative on this market. They've been negative for the last 27 weeks. Basically, since the market crashed, they were negative. They were negative all the way back up. So, got to wait for that thing to flip around bullish. I mean, it could be this week. We're going to get the survey tomorrow. And I'll put it out to my subscribers on Thursday with the full breakdown and the analysis. Also, I took a look at the CFTC's Commitment of Traders report, the most recent one that came out on Friday. If you look at the S&P E-mini contract, which is by far the most popular index contract, you have dealers, and the dealers they're the big Wall Street brokerage firms, okay? Goldman, Morgan Stanley, Merrill Lynch, all these, JP Morgan Chase. They are net long S&P futures. Now that's pretty rare for them, but they've been net long for about 11 weeks now. They've been riding this whole market up, this whole rally up. They started to reduce their long position in the last 4 weeks, but by a little bit. They're still net long over 100,000 contracts. Institutional asset managers, all right? Now this is an interesting group. You're talking about here BlackRock and Fidelity, those big guys that manage institutional funds. They are long, and they have been adding to their long position over the last 8 weeks. But basically, they just started getting long in July. All right? They didn't buy at the bottom in March. In fact, they had a very low position in March. They didn't buy in April. They didn't buy in May. They didn't buy in June. They only first started to buy in July. And now they're about 700,000 contracts net long. Just to give you some perspective on that, in the past, historically, we have seen market tops when institutional asset managers have over 1 million net long position in S&P E-mini futures. So they're 70% there. They're not completely there. I think we need to see that happen. Large speculators are short, and they've been adding to their shorts for the last 4 weeks. And here's what's interesting. Small speculators are short. Now, small speculators, don't take them for granted and don't knock them, because they were short in February before the market crashed. They called that perfectly, and then they flipped around to long in March, in late March, right at the bottom. And then they held that long position right up until mid-June. But since mid-June, they're short, and they've been sticking with that, although in the last 4 weeks, they've been reducing that down a little bit. So that's how it breaks down. I think you need to see the dealers go short. I think you need to see institutional asset managers all in. I think you probably need to see those large speculative funds capitulate. In other words, at the very least, bring down their short position. I don't know if they're going to get long. And I think you need to see the small specs flip from short to long. But if all of those things happen and the AAII goes bullish, then I think you have a scenario where the market is really crowded long and it's weak hands. It's the ones who waited a really long time to get in. Now, the Dow Jones today, we're like 900 points away from an all-time record high. Remember, the Dow is the only one, maybe the Russell too, but the Dow did not make an all-time record high. It recovered all of the decline since the pandemic crash, but it did not make an all-time record high. So I think you need to see that happen too. And that might finally convince individual investors to jump into the market. You know how it is. When people say the market, when we hear it on the news, what are they talking about? They're talking about the Dow Jones. So, dollar was down today, but it bounced a little bit. We got down in the dollar index to the 91 handle. I'm short. I sell every rally. I added to my shorts today. Gold was right up at 2,000 and pulled back, but the gold rally, the bull market is intact in gold. Actually, I like these kind of bull markets where it never looks like it's really going to get going. Same thing with the dollar on the downside, even though it's been going down, like you still have a lot of dollar bulls out there and people saying, oh, you see, every time it bounces, oh, that's it, that's the bottom. Every time it bounces, that's it, that's the bottom. I like these kind of moves because it's really easy to build a position as opposed to something like, I was in Tesla stock, and I'm going to talk about that in a second because, they had a stock split 5-for-1. And I did buy a little tiny position here today, but I'm mostly out of Tesla. But as you know, I bought it 400, 500, 600, 700. It went up to 1,300. I got out, and look at what happened. It went straight up to, 2,300. So I was kicking myself. But I bought a small position today. They issued more stock. They're doing a capital raise of $5 billion. Apple did a 4-for-1 split. I bought a little position in that. See how that works out. So that's the wrap. Yesterday I sent out the new edition of MMT Trader. Folks, you gotta have this. I mean, this is, if you're not following these flows, if you're not following what I do, you're basically throwing darts without any mental game. So you're not gonna make any money. If you're following that same, mainstream Wall Street garbage, what everybody else looks at, that's not insight, that's not understanding. That's guessing, basically. Most of it is out of paradigm. They don't know what they're talking about. What do you need that for? To lose more money? Go to my website, pitbulleconomics.com. Sign up for a 30-day free trial. Listen, I recorded a new podcast today. I'm going to put that up tomorrow, but I will remind you, all the links are here in the description below. If you like my comments, if you like my channel, please subscribe. Thanks, everybody. See you tomorrow. Bye-bye.